Welcome to the Portfolio Manager Views podcast from TD Asset Management. I'm Benjamin Gossack, Managing Director and co-head of Global Equity Portfolio Management. And I'm joined today by my other co-head of Global Equity Portfolio Management and also a Managing Director, Damian Fernandes.
Thanks, Ben. I find it really interesting. This is a PM talk, but we're both co-heads and PM. So who's doing the interviewing?
Well, right now I'm just doing the intro, but I'm happy to have this as a dialogue, as we normally do in our
day-to-day lives.
Day-to-day lives. I was going to ask you, do you think our title is too short or too long?
I think we just shorten it to probably something like maybe the team that leads to outperformance. You and I have been working together, maybe 14 years?
At least,
and counting. And over that whole time, we've been able to navigate what I think is a pretty tumultuous time in markets, and we've delivered for clients. So I'm hoping you'd ask, we can talk about what led to that, or we can just talk about whatever's on your mind.
Well, why don't we start with what's happening within markets from a macro perspective? So, a lot of what happened this year, people are looking back to last year as a guide for the future. Sometimes that works, sometimes that doesn't. History is important, but it doesn't always necessarily rhyme. We have had a big geopolitical event in terms of a war in the Middle East. There has been a lot of views in terms of the implications on a supply chain perspective, on an asset price perspective. And yet where we stand today, Damian, at this recording, markets are breaking out. So I've heard a lot of feedback, questions to myself, I'm sure to you, about are the markets getting it wrong? But the better question I want to ask you is, what misconceptions have been out there in terms of how people have viewed this market, and why breaking out to new highs isn't necessarily the market getting it wrong?
I think since COVID, what's actually happened is that the market has, I guess participants in the market and the media and sometimes our clients, they have overestimated the downturn or the fallback of geopolitical risk, and they've just underestimated the fundamentals. And let me just be clear. I think about COVID, the market bottomed in March, April of 2020, but cases continued to rise. The economy still slowed down, and people were like, "Oh, it's going to get really bad." It's like the market price is at the margin. More recently, last year, I think the playbook that you were alluding to, like Liberation Day, as soon as at the margin there was signs that there was going to be some negotiation on trade things, the market found a bottom and continued to move higher. There were signs that they were going to at least start negotiating. The market said, okay, the Strait of Hormuz is currently closed right now, but we see a pathway. And so I think you're right. I think the market is, correctly anticipating that there's going to be an outcome. And if that changes, of course, we'll have a thing down. But the second part of my statement, it's, we're overestimating geopolitical risk and we're underestimating fundamentals. Like GDP growth had a 5.5 handle last year. We're in the midst of earnings season. It's going to be the sixth consecutive quarter of double-digit earnings growth. And the companies we have in our portfolios, they're putting up really solid numbers. And I guess it's like every bull market. Things could end. What can, tip the apple cart? But they're forgetting about the delivery of earnings and cash flow right now. That's my view. What's your view?
I think I like to focus on a market structure perspective. We invest based on a certain philosophy, but we're not the only investors out there. And you have a whole bunch of people that are investing based on macro, micro, stock selection, volatility type portfolios. I think to your point, the market have started to prepare. They saw assets move into the Middle East, and whether they had foresight or not, when I look at it from a market structure perspective, they took out more insurance, or they prepared to short the market in a magnitude that was much larger than Liberation Day and COVID. So it was almost like they overdid it. And so we are getting, rips in the market to the highs. I know you like to look at factors. We're getting short covering a whole bunch of stuff, but they overdid it. And so, yes, there are real world implications, but from an asset price perspective, it's almost as if they priced in the Strait of Hormuz being shut down 10 times over.
I'm looking at the banks that reported last week. I'm looking at, core industrials. And a lot of these companies are breaking out to new multi-year highs. Like, what's your view on that within market? What's that telling you?
So I think it's a few things. Yes, we did get decent reporting from the banks, although I do think there is still a lot of risk in the banking system because of the over exuberance and the over
On
allocation to
private
private
credit,
credit.
exactly.
So we have a big issue in terms of geopolitics. I think we can't lose sight that private credit is an issue that's not going to go away,
The slow burn.
a slow burn. And we've had a few of these bankruptcies, but it's one where I would say for our portfolios, we've divested away from most of the financials. The sort of industrials breakout, I think, goes back to what's been really driving markets and GDP. It's a lot of AI. And we've had the hyperscalers talk about their 800 or $700 billion in CapEx. But you and I have looked at utility companies, and you could talk to 16 utility companies, in which I did in January, and they all had $30 to $60 billion
Yeah.
CapEx. So capital spending programs for the next 3 to 5 years. There's a lot of spending, and it's a lot of stuff on the hard stuff. So I hear people talk about, we're worried about AI, not worried about AI. They're focused on hard assets, but it's the demand for these hard assets to fill the data center as to why these stocks are working and why we're seeing earnings acceleration.
Look, the tax incentive policies in the One Beautiful Bill Act that was passed, we are pulling forward demand. Right now, if you're building a data center, if you're building infrastructure or structures, there's a tax credit you get where you can expense the depreciation. So, of course, you're going to invest as much as you can today. And that's showing up in the numbers, both the GDP numbers and the earnings numbers. And I think people are still thinking about, okay, when is the strait going to be open? It's like, no, we're in the midst of take the bird in the hand. The bird in the hand is, pretty significant outsized earnings and free cash flow growth. And I think, we should be comfortable with that. I know we're talking macro. That's just how I feel.
So cash flow growth has been a core ethos of our philosophy, and we like cash flows and cash flow compounding. I know you've been working on a research paper, but maybe you could illuminate what are the relationships you are seeing in terms of cash flow compounding and how that might then translate into stock outperformance.
Thanks for the shout out, Ben. And
I have no problem giving you layups.
so we will publish this, and it's for those that don't know, we actually have, and you know this, we actually have a separate team that does quantitative research based work, and we've always talked, like when you and Ben, you and I meet clients, we talk about how the marketplace is underestimating how much cash the companies we invest in are going to generate. So he thought, let's actually test that out. Let's assume you can find, before you can find a selection of companies, and within those companies, find the companies that 3 years from now grew cash flow the fastest. How did those companies compare sector neutral? Like if it's an industrial sector or if it's a consumer sector, the companies that grew cash flow the fastest from, from today versus 3 years in the future, subsequently, how did those companies perform? And we back tested this, and lo and behold, it's nothing surprising. The companies that grew cash flow the fastest actually had significant outperformance. And that's what our edge is, right? Our edge is today being able to look at our portfolios, look at what's in the marketplace, and try, and between a mix of our research efforts, our insights, our quantitative tools, what the charts and the technicals are telling us, try and place bets on which companies we think will grow cash flow the fastest. And like lo and behold, I'm pretty sure what the evidence will tell us is that if we're successful at finding these companies today that will grow free cash flow the fastest versus their peers in the next few years, our clients will benefit from some degree of outperformance. I thought it validated what we've been doing for the last 15 years, which is trying to find these cash flow compounders that you talked about.
So many people are so focused on analysts and their expectations
yeah.
for sales and growth and earnings. And if you provide inline results to your quarterly earnings, the market doesn't like that. The market wants outperformance. But if you're telling me that these companies are compounding their cash flows and they're outperforming, so then what's being missed by this community of specialists that their only job is to focus on these companies and their future growth potential?
Oh, I think what's being missed is time horizon arbitrage. And let me be a little more clear about that, right? You talked about the analyst community right now, the sell side analysts who work at the big banks and cover these stocks. They have a fair amount of they're stretched. They have a lot of companies to cover, so they're thinking about the next quarter. And you and I don't really play in the next quarter. We're not trying to buy the company that's going to beat earnings by 5 cents or sell the company that's going to miss earnings by 10 cents. We're thinking about what is being mispriced over the next, multiple years. Like, where do we see you had a great example about these utility companies that are investing, like billions of dollars in capex. And as soon when when you said that, the first thing about I was thinking about is that's probably more, like cables, and that's probably more, substations, and that's probably more, I guess like gas-fired turbines. In my head, I'm thinking if these companies are going to have outsized investment to, support grid infrastructure over the next multiple years, we can invest in these companies, but also let's invest in, like who this capex you're spending is someone else's revenue. Who is going to see the outsized revenue growth and the outsized free cash flow growth? And I know we always spend a lot of time on that. Maybe I let me switch gears here. Where do you think right now, given your view, like where are you seeing the bottlenecks and where the market isn't really pricing in this, stupendous growth over the next few years?
So the biggest opportunity, and I also do think the biggest risk to the portfolios is artificial intelligence. I think
Replacing us or
right now, I think we're okay, but I think we always should have an open mind.
yeah.
What I do see is, maybe in 2023, 2024, if you had a bullish point of view on artificial intelligence, it was very easy to say, let me own a company like an NVIDIA or a Broadcom because it seems everyone needs these chips. And so these companies provided these outsized returns. But like all things, we start to say, well, now that's consensus. We all know NVIDIA chips are going to be needed. So then what is the next thing where we can create the outperformance? And to your point, what are those additional sort of pick and shovel items that we're going to need? And so what we are finding now is if we follow NVIDIA's roadmap, and their plan is to create a new chip every year with new bandwidth, new speed, all this type of stuff to deliver all the demand that we want from our AI models, we're going to need a lot more cables, but an exponential amount of cables. So, when I think about could the analyst community figure out, is it 3x next year cables? Is it 4x next year cables? That creates a lot of opportunity if they undersize how many blue cables are required. Even as something as trivial as the green printed circuit board. So if I were to open up my computer, I'm going to find all these green boards.
Yep.
They got all these chips. Because of the speed and the bandwidth and the temperatures, and electrons are not like a fluid. They kind of like to move where they're going, and everything's getting miniature. Just containing it and having the right material is becoming key. And there are only a handful of companies. There might be one company that does 70% of that. And so that's where it's getting exciting, because I always find for us that, we want to see the signal, we want to see growth. I really do believe markets reward growth. And then trying to figure out from a puzzle perspective, okay, well, where are we going to benefit from that growth? We benefited from NVIDIA, and that's not going to go away, but we're not going to get outsized outperformance, because what's really important for people to understand, the way that you and I talk is always in relation to the fact that we have benchmarks.
Yep.
And, if a stock goes up 15%, let's say you own a stock and it goes up 15%, you're like, wow, it's up 15%. I made a lot of money. But for you and I, if our benchmark goes up 20%, that stock that's 15% that might delight someone is actually a big disappointment and a really hurt to performance. So we are always trying to figure out from our perspective, because we manage portfolios to benchmarks, is this better than the broader market? And if it's not, it's a disappointment.
I guess that's the point of my paper. It's that empirically, evidence-based, the market does reward growth. If you can find companies that are growing much faster than their peers in cash flows, the market rewards that. You said also something about NVIDIA, and maybe we'll drill down, a little deeper there. Is it that the market doesn't care that NVIDIA is going to generate $500 billion in revenues?
as to why the stock hasn't
Exactly.
outperformed.
It hasn't outperformed. We know this. We own it. It hasn't outperformed since I think October last year. It's just been, it moving sideways.
So I don't think it's an issue about the numbers. I think it's more about more and more people have a better appreciation for how big the market is. It's very similar to when we approached the obesity
Exactly.
and the diabetes drugs that were coming to market.
Names like Novo Nordisk and names like Eli Lilly.
Right. So they were very expensive from a, let's say, a PE or enterprise multiple perspective. But as they were growing and ramping up, what we could tell is that the market couldn't appreciate
Yep.
how big it was.
They just thought it was for people who were
Well, the initial take was, you wouldn't take these drugs unless your BMI, so your body mass indicator, so that would be height to weight ratio, was north of 30. The analyst community couldn't contemplate why you would take it if you had a BMI
exactly.
less of 30. But I think these stocks can grow as people realize how big these markets are. But now it's not as if Eli Lilly and Novo Nordisk and all the other companies that are putting these drugs are not successful in growing earnings and cash flows. Is that we've, I think for the most part, kind of figured out how big this thing is. And even as NVIDIA was ramping up, you get 3 quarters of outsized growth, and you're like, well, it couldn't be the next quarter. They couldn't grow as much. And here we are in 2026, and they keep putting up amazing numbers. But I think it's not lost on anybody that the GPU is really important. And I think that's what's factored into the stock price.
Yeah, like we call it exploitable alpha, right? The fact that when we mean exploitable alpha, what we're really trying to think is that does the market underestimate how or overestimate how big the opportunity set is? And for us, like to your point, like we actually in our portfolios, we don't actually have big. We still own Nvidia. We think it's a super high quality company. It's growing, but it's no longer exploitable. Like people understand that there's going to be $500 billion of revenue and really high margins, and you were talking about bottlenecks, and we're finding really great opportunities in the makers of the materials that go into circuit boards or the companies that make the optical cables, because as these data centers, you need to connect them together. You need high bandwidth transmission, and that's optical. So I kind of like what I was thinking. I want to switch gears maybe and switch it to something, and then you can talk. You go first. What do you think? And hopefully we don't have the same answer. Is we'll end on something where we'll end on a positive note, but like what's really keeping you concerned right now? Both either maybe individual stocks in our portfolios or at the market writ large.
So I would say the biggest challenge I have right now is I like to look at the world less on geography. So I don't think of, is it Canada's this year, Is it US year this year? Should we
Yeah.
move everything to Europe or Asia? I think that's more of an output of our process. And I don't also think of the world based on sectors. So should we allocate to industrials or
Yeah.
technology or to utilities? I also think that's an output of our process. What I'm really concerned about, and I think more and more people, especially advisors, if they run their own models, should look underneath the hood and determine, let's say they run a 50 stock or global portfolio, or maybe they run a 40 stock. Let's focus on the US. Let's say you run a 40 stock concentrated US portfolio. Is it possible that 30 of your stocks are actually all the same stock
Because they're all tied to the winning AI theme.
because they're all tied to AI? And I'll give you an example. So right now, what's in short supply are these natural gas combined cycle turbines. It's only produced by 3 companies, and every utility wants these gas turbines that power the data center. But there's a 5-year, 6-year backlog. So if you sign a contract with a company like Amazon, and you're like, great, we will build you this power that we agreed to, that maybe when you put the firm order in for these gas cycle turbines, and all of a sudden you got to wait 6 years. So the industry is looking for short-term solutions, and they're focusing on these engines called reciprocating engines, but they're effectively sort of backup diesel generators. You could find that in certain industrial companies like Caterpillar. You could find that in energy services
Yeah.
companies like a Baker Hughes. You can find it in some other nat gas companies that are packaging these solutions and reselling these reciprocating engines. And so you may be diversifying
So I own
based.
an energy company, I own an industrial company, I own a tech company, but it's basically the same trade.
It's the exact same tray. And that's the same thing with the bottlenecks in the data center. You could own like we said, you could own the blue cables, you could own someone that makes that printed circuit board, someone that solders it, someone that puts the little lines
Yeah.
on it. In reality, if you're truly being honest with yourself, they're all the same stock because the market is treating them all as the same stock. But it goes across
I know.
the industry sectors. So in the past, I think when you and I would have started working together, let's say 14 years ago, it actually made sense. Oh, Damian is over indexed on industrials and financials. He must be he must think there's a cyclical
Exactly.
business cycle. And I think the market has changed from that point of view. Whereas like you said, you can pick up AI and utilities, industrials, technology,
I
discretionary,
know.
communications. And as we've seen with this private credit issue,
The funding for them too.
right, you pick up on the financials. So it's all over the board. It's not impossible, but it is a challenge to find ideas that also growth and diversify you from just this one dominant
Yeah,
theme.
I was hoping it wasn't the same thing, but it is basically the risk factor. And I think the risk factor, I'll just put it plainly. You said at the start, it's going to be 700 billion in capex tied to data center. That capex is someone else's revenue, and it's someone else's revenue across multiple sectors. The utilities are providing more power output. The industrial companies that are helping connect the utilities to the data centers. Within the data center, the tech companies that provide the optical cables, and the financing companies that are providing the credit to build these data centers. It's all become one big trade in the U.S. market, and the numbers are astounding, right? 700 billion. Assume 75% of that is spent in the US, 75 multiplied by 700, you get to, half a trillion. The US economy is a little over 30 trillion. You're talking about 1.5 to close to 2% growth just coming from data center buildouts. If like what I'm laser focused on is whether any of these hyperscalers start talking down numbers, because I think that, and we know this in our portfolios, that's going to be the big risk, because all of those stocks, you can say you're diversified, but all of those stocks will feel pressure if we start seeing reductions in the amount of AI capex build out. Do I think it's happening? No, because I think you're getting compensated this year for actually putting money in the ground because of the tax incentives. So if anything, I think this year you'll probably see increases in the capex build because they're incentivized to do it. But that is a longer term worry.
I get a lot of questions about views on the US and whether we should diversify away
Oh
from the
yeah.
US. Um, I might know your answer. I might not actually. I could be surprised here, but from your perspective, do you think it's people should just dismiss the US and just focus on Europe or Asia or Canada or emerging markets?
I found it really instructive that we're filming this in the middle of April, and if it was Feb 28th, the amount of people that told me it's the end of U.S. exceptionalism and the U.S. dollar is not worth any money and there's going to be diversifying away. Then we had a war, and the U.S. market was the best performing market in April. The U.S. dollar was the only place of actual that provided you ballast. Like gold was off 15%, Bitcoin, we don't even have to talk about that. A lot of defensive sectors, and the rest of the world that are rightly so, because a lot of these countries import energy. They would put pressure, higher energy prices would put pressure on budgets, which means less money for stimulus. A lot of the rest of the world actually underperformed. My view on the US is you still have probably some of the best companies globally growing at much faster rates, and almost like a capital return policy in the companies, both with share repurchases and dividend growth, that are quite attractive. How we don't actually pick countries, but I would never be dismissive of the US. And you just had a real life example where in a time of crisis, a war, the US market, the US dollar, and US assets actually held up really, really well. What's your view? Do you think people are just overly dismissive about this?
I think last year it was a very emotional reaction
Oh yeah,
because
as Canadians.
as Canadians and maybe as
Yep.
Europeans and maybe other countries because it was, we're cutting off trade and so there was an emotional reaction. If I'm just, looking at it, you know, from just sort of I think more people have to focus on index composition. We're very focused on, oh, S&P did this,
Yep.
TSX did this, MSCI World did this. The reason why Canada did so well last year has less to do with the Canadian economy and the
Which
Canadian
actually,
business
yeah, which
cycle.
was actually not that. great to begin with.
and had everything to do with the fact that the Canadian market probably has the biggest exposure to gold stocks.
Yep.
In the S&P 500, there's just one gold stock, Newmont, and it may not be of the same caliber as the other gold
Yep.
stocks. Same with Europe. There is some gold, but again, it's not going to dominate the index. What dominates the U.S. and why the U.S. has had all that so-called exceptionalism is the fact that it has the largest exposure to technology. I always find when large cap tech underperforms, it makes Canada look very
Oh,
good.
completely.
It makes Europe look really good. And if you had a view like, oh, we got to go to Europe, it's a very convenient it's a very convenient argument based on large cap underperformance. And the thing that actually really surprises me, and it's not being discussed. So we do have large cap tech underperformance right now. In fact, people would have said, hey, Damian, the biggest risk to the US market right now is the fact that it's so concentrated
Oh, I
to
know.
7 stocks. Those 7 stocks, based on, I have marketing decks and we end on March 31st. In our snapshot, from a year to date perspective, all 7 of those stocks had actually had negative stock returns, and the S&P 500 broke out to new highs.
What's behind door number 3?
Exactly. I always find when everyone says there's only 2 options or 3 doors, there's always a 4th and 5th. So I think if we get a renewed return to large cap tech, then all of a sudden, I do believe prices drive sentiment. And then there'll be a reorientation of the U.S. exceptionalism. And everyone will say, you know what, we should go back to the S&P. Maybe there's value because we've all been focused on other geographies.
I think what you talked about before, composition, even when you think about EFI and stuff, there's just a few sectors within EFI. Last year, one of the best performing sectors globally, you talked about gold, but were things like financials. And EFIs over indexes with higher weights to financials. So maybe it's just, people are confusing the sector composition with the country selection. And I think you're right. I think and the second thing you said was, just like a lot. I was thinking about the tourist idea. A lot of tourists in Europe, a lot of tourists in EFI. And as soon as like things got like a little dodgy, they started like coming back home, right? Coming back home to North America.
Now, financials, to your point, were outperforming and they over-index in Europe. But financials have been outperforming MSCI EFI for over 5 years, Damian. But people only discovered it last year because of the large cap tech underperformance. Otherwise, they were happy with the US. I think I'd like to sort of move to sort of one final question. I'm curious about your thoughts. I think you and I get a lot of questions about, where do we think markets are going to go? And I think we both agree that trying to forecast is, if people want a forecast, there's plenty of people that will provide it for you. But what do you think is a better question if someone was coming to see you talk, an advisor was coming to see you, rather than waste time saying, hey, Damian, tell me where markets are going to go at the end of the year, what would be a better question that would create more of a value conversation?
I think the question for me is like, what excites you? And what excites me is that, look, you and I will never tell people that we think the market's going to correct 10 or 20, 10 or 15%. Technical corrections, like 10% drawdowns, happen with a certain degree of frequency every year. Being able to, anticipate that and be really convinced that you can do that, like that's like we're deluding ourselves. But I think what people are forgetting is just the bigger picture thing. We're at the cusp of a massive technological revolution that is probably across the board going to lift margins. So if you had, just like companies that had margins today, and there's a chance that margins will move higher in the next few years, that should probably mean higher valuations for those companies, right? Because they'll generate more cash flow. And I think people are so, they're so in the weeds about thinking about, hey, what could go wrong, that they're not thinking about what could go right. Like, we're in a multi-year bull market. Like, earnings are growing above trend. We have margin opportunity and capture, and we have, governments globally that are spending to incentivize to actually have faster growth. I think those are all really, really bullish. And I'm really excited about, I'm excited about our products for the next, 3 months, but I'm extremely excited about our products and our solutions to help advisors over the next 3 years, because I think that's where we add alpha. The fact that, we can find these companies that have outsized exposure to faster free cash flow growth, and it might not be rewarded the next 3 months, but I'm pretty sure the next 3 years we'll look back at it and say like, oh wow, that actually happened. And I think people are, living in the negativity of the moment without actually seeing what's the upside potential. That's my thing. Well, if I reverse that question, right? If someone asked you like, Dave, Ben, don't give me a forecast for the next 12 months. Tell me what really is on your mind for the next 3 years. Like, what's your thoughts?
Yeah, look, I think it goes back to our secular trends and cycles, the areas that we think, again, we focus on secular trends and cycles because we think that leads to growth. Find the companies that can capture that growth. We think we can get the outsized returns. I think it goes back to what I was saying before is our objective is to manage and outperform to
Yeah.
a benchmark. And I think for the advisor, it will vary based on client, but do we need to deliver 6% compounded returns for this client because they have certain financial goals and dreams and aspirations, and this client requires 10? So maybe from a perspective is we are the ingredients that go into a model portfolio for an advisor. Are we helping them
Yeah,
get to those objectives? And maybe that's where we can have a more fruitful discussion.
I agree completely.
Damian, always a pleasure. I mean, hopefully this gives people an insight to the kind of daily discourse that you and I have.
Yeah. This feels very transparent because obviously we haven't prepared for it, and it's like, let's just talk about what's on our minds.
Right. So I want to thank everyone for watching the Portfolio Manager Views podcast. And we look forward to coming back in a month's time with another content-filled episode.